Who cares where I purchased my home run stock that has since taken off and done extremely well? Well, your kids care and your loved ones care, and they care a lot. At Brandywine Oak, we like to say that investments are a matter of opinion, but taxes are a matter of fact. A topic that's been confusing for clients as it relates to leaving their hard-earned life savings to their heirs is which of my assets will pass tax-free to my loved ones and which of my assets will pass with a tax bill attached. All assets at the time of death fall into one of two categories: what is called income with respect to decedent, or IRD assets, and non-IRD assets. In the simplest form, non-IRD assets are assets held within after-tax accounts, homes you own, an antique car collection, a collection of historical cartoons, or Japanese woodblock prints, or any asset where you used after-tax money from your checking account to purchase them. These non-IRD assets are in fact assets that have a characteristic called a step-up in basis. A step-up in basis is, of course, financial jargon. In plain English, this simply means that capital gains taxes are erased at death. Let's use a real-life example. My Meemaw took $10,000 from her checking account and used it to buy Apple stock in the 1980s. As low-cost diversified index funds were not an option back then, nor was I born to advise her. The stock went up 100 times, is now worth $1 million. If Meemaw sold this Apple stock the day before she died, she would pay capital gains taxes on $990,000. Yikes. If her kids sold the Apple stock the day after she died, her kids would actually pay $0 in capital gains taxes. Why? Because Apple stock is a non-IRD asset, and therefore capital gains are wiped clean at death. Let's compare this now with my granddad, who invested the same $10,000 into Apple stock in the 1980s. It went up 100 times, just like Meemaw's Apple stock did. However, this purchase was made inside of his before-tax IRA. It's also worth $1 million, of course, but an IRA is by definition an IRD asset, and the income tax does not get wiped clean at death. So when the kids inherit granddad's Apple stock, they're responsible for ordinary income tax on the $1 million at their own individual tax bracket. An IRA, we like to say, is a very expensive asset to inherit. We always want to invest like an optimist, but pay taxes like a pessimist. Now, you might be wondering, what other types of IRD assets are there? IRD assets include all retirement plans such as IRAs, Roth IRAs, 401k plans, health savings accounts, and deferred annuities. These accounts all share a common feature. The tax benefits and obligations they have will pass on to your loved ones when you pass away. In simpler terms, if you leave a pre-tax IRA to your kids, it remains a pre-tax IRA for them. A Roth IRA you leave to your kids stays a tax-free Roth IRA. For example, if Granddad bought Apple stock in his Roth IRA, the kids would inherit that $1 million tax-free. If that stock doubles over 10 years, the next $1 million of gains would also be tax-free inside the Roth. At Brandywine Oak, this is why we spend time educating clients on why asset location, a separate topic for a separate video, is critical and cannot be overlooked. If you have any questions, scan the QR code to see how we can help.